The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the May webinar titled Securing Your Retirement, Transforming Social Security into a Winning Retirement Strategy, courtesy of BlackRock. We appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we'll be taking a look at some strategies to help you maximize the benefits you can expect to receive from Social Security. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we will take some time to go through these. With that said, I'd like to introduce our guest speaker, Allison Rumpp, Associate and member of the U.S. and Canada Defined Contribution Group within BlackRock's Global Retail and iShares businesses. Allison is responsible for internal sales in the Southeast region as part of the retail distribution team, as well as managing the internal sales desk. I'd like to thank Allison for joining us today, and with that said, Allison, I'll now turn it over to you.
Great. Thank you so much, Christine. Good morning, everyone. As Christine said, my name is Allison Rumpp. I'm going to talk to you a bit today about Social Security and really the strategies that we've been afforded to start collecting and make the most out of the money that we've paid into this system for years and years and years. I will ask you, though, to keep in mind that as we know, sort of the trust fund of Social Security is projected to deplete, in 30 or so years. So they are doing some adjustments here around how do we allow people to start to withdraw on their benefit? How do we allow people to collect? And really, what are the strategies that we're going to allow going forward? So the strategies that I talk about today really are aimed to target individuals age 55 and older, because everything that we've seen so far from a legislative standpoint has grandfathered those individuals, 55 and older, into the current legislation. So anything that is currently available today, 55 and older, you should be able to exercise those rights throughout your retirement whenever you choose to collect your benefit. So with that being said, let's really just get into the meat of this presentation. And as we look at Social Security and how we're going to collect our benefit, this is a component, this longevity issue is a component that you should be considering whether you're looking at Social Security, your 401k, your IRA, your home, any sort of retirement strategy. You need to think about your life expectancy, and I'm sure this is nothing new to anybody out there, but we are all living longer. And I like to sort of jokingly say here, males age 65 and older, if you get to 65 and you're healthy, you have a 50% chance of living to 85 and a 25% chance of living to 92. And women age 65 have a 50% chance of living to 88 and a 25% chance of living to 94. And we won't make any comments around why females tend to have longevity on their side more than a male does. But then if you look at couples, this is where we're going to start seeing not only is longevity on their side, but having a conversation around Social Security strategies is really, really important. So couples age 65 and older, happily together couples age 65 and older, at least one of them has the 50% chance of living to 92, and one person has a 25% chance of living to 97. So this is a huge amount of time that we need to start planning for retirement. And that's why you can't just look at the Social Security estimates that you get and let's just start taking money when we can, because there's a lot of nuances that have to go into that decision-making process, and we'll go over them today, but really trying to drive home that there is a really, really good chance, barring anything you definitively know about your family history or your own health, that you're going to live 20 or plus years in retirement, which should be this amazing, wonderful time that you've all saved for. And so we don't want it to be an experience where trying to draw down the money is more stressful than making it during your working years. So if we look at Social Security benefits, most people, as you see here, 73% of individuals collecting those benefits today are collecting a permanently reduced benefit. And we'll really dig into what that means. But they've collected prior to their full retirement age. So they've collected a benefit, it's permanently decreased. Only 27% of individuals have really taken advantage of the system. And so we'll see what that means in a few slides, but this is something to really take into consideration as you start to look at your strategy going forward. So the rules of Social Security benefits. Individual benefits. Most workers pay into the program with each paycheck and will qualify for Social Security benefits at retirement. Workers pay the FICA tax up to Social Security wage base of $117,700 in 2014. So if you look at those tax limits as they come out every year, this is indexed upwards for inflation if it's applicable, but every year you will pay into Social Security up to that limit. You'll pay that sort of tax on there. And you'll receive this chart right here that you'll see, your earnings records. You won't receive it as often as you used to because as part of their cost savings, they don't send this out every year, but you can absolutely have access to any of your records on the Social Security website. So you want to make sure that these numbers are correct, that everything that they have here for your earnings is accurately reflected so that when they are calculating your benefit, that's also correct. When they look at your earnings records, they will take your best 35 years of work history. And I really want to highlight that and sort of dwell on it for a second. It's your best 35. It can be that you worked for 10 years, had really good earnings, took a break for 5 or so years, and then went back to work. And they will cherry pick those best 25 years. It does not have to be consecutive. And as you continue to work throughout your career, those lower 35 years will drop off and will be replaced by the higher 35 years. And anytime that you don't have a total of 35 years of work history, they put zeros in for that placeholder when they do the formula to calculate your benefits. So a lot of times I'll be asked here, you know, I had 30 years of really great work history. I'm ready to retire, financially ready, and I want to start taking my benefit. Do I get what I was told? And I have to say no, what you're told is an estimate, and it's based on the last 35 years. So if you have 5 years left out of that 35 that you haven't worked, those are zeros that are going to be populated in there. So when they start to pay you out, it will actually be a drawdown. So potentially going to a part-time work or to continue to work would be beneficial for that Social Security wage that you would receive. The top right that we just show here, your estimated benefits, this is on the sheet that you'll receive once you hit 60. Once you hit 60, I believe, it might be 65, they'll start mailing it back out to you. But these are purely your estimates, right? So based on the 35 years of work history that you have logged, they will start to estimate your benefit. And if you don't have 35 years yet, what they do is they look at the last 2 years that you have filed with your wages, and they average that wage, and they project that through age 65 or 66. So when you get these estimates, if you stop working, that estimate is way off because they're assuming you're going to continue work and you're going to continue to make what you made in the last 2 years of that work history. So remember, this purely is an estimate, but it does give you some idea of what you can look at. And here's the line item. So at your full retirement age, in this example 67, your payment would be about $1,500. So we'll revisit this term again, but full retirement age, that is your primary insurance amount. This number, that top line, is what all of your benefits will ever be based on, whether they give you an increase in benefit, whether they give you a decrease in benefit, whether they allow you to take a spousal benefit or your children are eligible for those benefits. Everything is based on this full retirement age amount. Age 70, as you see, you get a little bit of a raise if you wait. And then age 62, you get a demotion, more or less, you get a permanently reduced benefit of a little over $1,000 in this example. And here's the website here. If you are not getting statements yet, you can log on to the website and you'll be able to pull up your own statements. You'll have to have your information. You can share it with your financial advisor for any sort of advice that they would be able to give you based on these numbers. So I mentioned, and we looked at the highlight on the last page around if you take it at age 62 or if you wait until you're 70. So here, anytime you take it prior to full retirement age, you are going to have permanently reduced benefits. The primary insurance amount at your full retirement age is what all the calculations are based off of. So you want to keep in mind what that number is whenever you do any of your calculations. And then anytime you wait past age 70, they give you a raise. So you'll receive an increased benefit up until age 70. There is never any benefit to waiting past age 70 to collect your own benefit, but they do give you a raise from your full retirement age up to age 70. Here's a little cheat sheet for your own personal reference around what your full retirement age would be based on when you're born. So this is another example of the Social Security Administration trying to have some cost savings into their analysis, and they're going to increase that retirement age. Who knows if they continue to increase it past 67 as we go forward, but 65, 66, and 67 are the current ages that they're publicizing today. Now here's the math for the collecting early cost. If you start as early as you possibly can at age 62, you're going to take a permanently reduced benefit of 25%. So you will get 75% of that full retirement age benefit at 62. It does not increase as you continue to age. Whatever you get at that point, you've locked in. That is your permanent amount that you will receive. You will get slight increases every year for cost of inflation, but that's it. If you wait every month past 62 that you wait, you will experience a raise, more or less, in that benefit until you get to your full retirement age, at which point you'll receive 100% of that amount. You can see on this bar graph the linear approach to getting more and more of your full retirement age benefit the closer you get to full retirement. And that reduction is purely based on the age at which you start collecting your benefit. So if you collect early, you should consider a lot of things. We talked about in the beginning your longevity. What's your health? What's your family's health? We started to allude to your spouse. Are you married? What's the age difference? What are the benefits from a household that you could receive by starting to collect early? One of the real big key things that you should consider is, are you going to actually stop working? Because if you're not going to stop working, you're going to have this further reduction applied to your benefit if you meet these limits. So the year that you start collecting, if it's prior to full retirement age, if you make more than $15,480 that year, for every $2 over that amount, $1 will be withheld from your benefit. So for example, and we'll do some rough math here, if you were to make $30,000 a year, that's $15,000 over the limit, which means your benefit would be reduced by $7,000 a year. The year in which you reach retirement, you actually have an increase in the amount that you can make. You can make $41,400 the year that you turn 66 or 67, and you can make that money from January until the month of your birthday. So if your birthday is in June, from January to June, you can make $41,000 without any benefit withheld. If you make over that, though, for every $3 over, $1 of the benefit is withheld. And then once you reach full retirement age, there is no cap on your earnings. So this is why working is such a huge question for you around collecting your benefit. Because if you are not going to continue working, you won't have this income limit experience, and then there will be no further reduction on your benefit. One thing to remember is that when they realize that you've reached this limit, it's usually at year end when you file your taxes. So what that means to you is that once they realize it, 100% of your check going forward will be withheld from you until everything that should have been withheld in the prior year is paid back. So from an income flow standpoint, be aware of that case. You do have the ability to go onto the website or talk to a Social Security administrator about having it withheld throughout the year. But if you don't do that, it's 100% of your benefit every month that should be paid until everything is paid back to you. So just be aware of that from a budgeting standpoint. Now, the Social Security Administration does allow you to have what we call the ultimate redo. So you've decided to file for your benefit, you started collecting, and then you've heard this webinar, or you've talked to a consultant, or you realize that you need to go back to work, or that there's an income limit, and you don't want to take it anymore. Within 12 months of initially filing for your benefit, you can request for withdrawal of application. By doing this, once it's approved, you would pay dollar for dollar what you have already received from Social Security back, and then you could refile at a later date as if it's the first time that you've ever filed. So there's no interest on it. It needs to be done within the first 12 months of your initial application to receive benefits, but then you can change your mind, you can start to collect your benefit at another point in time down the road, and you'll experience either less of a reduction on your benefit, no reduction, or an increase in your benefit depending on when you start collecting that benefit. Collecting late. For every year in which you wait, you are awarded a guaranteed increase on your benefit of 8% per year. Every year you wait past your full retirement age, you get an 8% guaranteed return every year until you reach the age of 70, for a total of 32% on top of that full retirement age. Now, I don't know about you, but in the past 5 or 10 years of this market cycle, a guaranteed 8% return sounds pretty nice. So if you don't have longevity on your side, if you don't have, if you do need the income, then it may not be a strategy for you. But if you do have longevity on your side, if you do have a spouse with a big age difference, if you do have family to consider, these are all things that you should consider waiting for, and to wait and maximize that total benefit. I often get asked, what's this break-even point? When do I benefit versus the government benefits by when I start taking the income? And now it's pretty easy to do this break-even analysis if you're collecting just by yourself. So if you start collecting at age 62 or 66 or 70, here's the analysis that you can do. It can be done with the Social Security Administration. They are more than happy to do this. There's some tools online that will help you do this analysis. But it's more or less the straight math problem of income in times how many months do you receive it, versus if you wait to 66 or 70 to see across a break-even point there. But when you start to really think about your family and spousal benefits and survivor benefits and children benefits, this is when this calculation becomes a lot more complicated. So now we're going to get into what those strategies look like and how all of these people in your life play a role in your decision to collect your Social Security benefit. Bear with me. We're going to get into the math now, and some of this gets pretty complicated and hairy, so I will absolutely take questions at the end, as Christine mentioned. Type them in the chat box as we're going through, as they pop into your head, because the math gets funky, and I want to make sure everyone is clear on this. So here we go. spousal benefit. John has $2,200. Jane has $0 for their primary insurance amount. So this one's pretty easy, right? Jane has no work history of their own. A spousal benefit is equivalent to 50% of John's benefit. So, straight math, Jane gets $1,100 at full retirement age if she collects a spousal. Here's where you start to see some strategy. So filing and suspending. In order for Jane to be eligible for a spousal benefit, John has to have at least filed for his benefit. And this is some just nuanced vocabulary here, but if you file for a benefit and you're at your full retirement age or later, that means you don't have to actually start collecting. But you could, if you wanted to, you could file and start collecting. So at age 62, if he files and collects his benefit, no problem. When Jane turns 62, she can start collecting that benefit. Or he could wait until he's his full retirement age, and he could file, and when you're full retirement age, you can sort of say to the government, I'm going to file this benefit, but I don't want to start taking it. It's more or less for the pure benefit of Jane, my wife. She's going to start collecting this benefit. So you suspend your benefit, and then you start collecting it at full retirement at age 70. You've fully maximized your own benefit by doing this and waiting till 70. All the while, at full retirement age, Jane is collecting $1,100 a month. So keep in mind that the decrease in your benefit is always based on the person who actually collects the benefit. So if Jane is collecting that money, you want to make sure that she is full retirement age when she starts collecting, or else she'll have a decrease in her benefit. The file and suspending, that's also based on the primary breadwinner's age. So John will not be able to file and suspend his benefit if he's not full retirement age. As we saw in the past, spousal benefit is just like your own benefit. There is a decrease for every year in which you start collecting your benefit prior to your full retirement age. So based on when Jane collects those benefits, it can impact the total amount she takes home. If she collects spousal benefit prior to full retirement age, her spousal benefits will be reduced. A maximum of 30% if she waits if she starts collecting as early as age 62. She would only get 70% of that $1,100 at age 62. However, unlike when you collect your own benefit, there is absolutely no benefit to waiting past full retirement age for the spousal benefit. So as you look at yourself or your employees and you're trying to help them navigate this whole retirement puzzle piece, look at your spouse's full retirement age benefit and then your own benefit at age 70. If half of your spouse's full retirement age benefit will always be more than your own, will be higher than yours at age 70. There is no reason at all to wait past full retirement age to start collecting the Social Security amount. The only reason you'd want to wait is if your spouse can't start collecting their own benefit yet. Adding spousal benefit to individual benefits. So this is some math just for you to be aware of how the administration sort of calculates the spousal benefit if you have your own insurance amount. At the end of the day, when you get a check, it's one check that comes to you, but this is for understanding as we get into some of the more complicated strategies going forward. So if Jane collects her own benefit at full retirement age, in this example, she would receive $600. If she collected her own benefit at age 62, that would be reduced by 25%, so she would receive $450. If she waits until age 70, she would get $792 of her own benefit. But remember, she's married to John, so she's eligible at full retirement age for half of his amount of $2,200. $1,100 is what she's eligible at full retirement age. So at full retirement age, the breakdown of the two is $600 of her own plus $500 of that spousal benefit to get us to $1,100. The difference between your own amount and the total amount you're eligible for through your spousal benefit is what now they're considering your spousal benefit of $500. If she collects early, remember we have a reduction on your benefit of 30% of this $500, so you get to $350. If she starts collecting both her own and her spousal benefit at age 62, her total income will be $800 a month. Remember, I just said in the last slide, though, that there's never a benefit to waiting past full retirement age if that benefit is more than yours will ever be. So here, hers at age 70 is $792, much less than the $1,100 that she's eligible for from John. So if she waits until age 70, she's only going to get $308 off of that spousal benefit. Have still a monthly income of $1,100. Jane should never wait. She should always come over here to the full retirement age and collect at the latest this age. So when we think about the spousal benefit and we look at what is being collected, most women are collecting a part or all of their benefit from their husband. And this is really important when we start thinking about survivor benefits, because this is how, as the primary breadwinner, and this is all historical data, so if we think about the stereotypical home in the past, the wife stayed home, was the homekeeper, and the husband went out and worked. So having this sort of representation of who's collecting what benefit is very understandable if we look at history's context. Going forward, it could absolutely be the reverse, where the husband would be collecting some of his benefit off of the wife. Needless to say, for this example's sake, we need to be understanding of how a husband and wife collecting these benefits really plays into the role of survivor benefits. Because as a survivor, you are eligible for 100% of what your spouse was collecting at the time that they passed. So if we look here, John's benefit at age 63 and 6 months was $1,833. If John passes, and this is when he starts taking his money, Jane is eligible for this at his passing. If John waits until he's at age 70 to take his own benefit, he will collect $2,900, which is what Jane is eligible for collecting. So looking at not only your own longevity, but your spouse's longevity is crucially important to deciding when we should start collecting this benefit, because the surviving benefit is yours. It's the highest one. So you want to make sure that you're calculating, and this is why that break-even point math isn't as simple when it's just your own. So now that we sort of know the nuances of how the benefits are created, who can collect off of your benefit, let's talk about some strategies to collecting this benefit. So if a married couple, age 62, that they start to collect, we're going to work with the same numbers. John's primary insurance amount is $2,200, Jane's is $600. If both start collecting at age 62, John would receive his own monthly benefit of $1,650, reduced by the 25%. Jane would receive her own monthly benefit of $450 until John passed away at age 75. She would receive an additional $350 as a spousal benefit until he passed away. We're assuming that they're both of the same age, so as soon as John starts to file and collect, Jane may start to file and collect as well. When John passes away, Jane would be eligible to receive $1,815 as the survivor benefit in lieu of her own benefit. You can only collect one benefit at a time. So you're either collecting a spousal, or you're going to collect your survivor benefit, or you collect your own benefit. You can't collect your benefit and a survivor benefit at the same time. At the end of the day, their total income is $564,000 from Social Security. Now, what if they collect at age 66, their full retirement age? John will receive his own monthly benefit of $2,200. He files and starts collecting. Jane will take her full primary insurance amount of $600. She will receive an additional $500 of spousal benefit to give her the total of $1,100, 50% of John's, since she waited until full retirement age. Oh, sorry. Giving them the grand total of $580,000 once in all money is collected. Now, if we wait and have them collect at age 70, John will collect his full maximized amount of $2,900. Jane, again, like we had mentioned before, because her max amount is $1,100, she's actually leaving money on the table. Nevertheless, she'll get $792 from her own, $308. Once John passes at the age of 75, she'll start taking the $2,900 a month instead for survivor benefits, giving them a total of $532,000. So at the bottom here, we can see that in this example, both lifting at a specific age together, waiting until full retirement age gives us the best bang for our buck. But there's a strategy here that we can start to employ. What if there is a large difference in benefits like in this example? How could we sort of play the system and make it work for our most advantage? Jane here, the lower wage earner, could start collecting as soon as she possibly can at age 62. Because John has not filed, she's not even eligible for a spousal benefit. So she'll collect her $450. Then, once John reaches full retirement age, he'll file and suspend, filing his benefit for the pure benefit of his wife and not collecting his own, so it will continue to grow. At which point, Jane will then say, all right, I'm ready for my spousal benefit portion. And because she waited until full retirement age to start collecting that spousal benefit, she gets 100% of it. So that $500 of the difference of her own primary insurance amount of $600 and $1,100 gives us $500. Then, at age 70, John will fully maximize his own benefit and collect $2,900. And even though he only gets to receive that for 5 years, he's giving Jane the higher survivor amount as she lives through age 82. And in this instance, this strategy will give us the most income from Social Security. Now, what if we add longevity to the equation here? And John lives to 85 instead of 75, and Jane lives to 92. Again, having this staggered approach to collecting your benefit gives you the most money from Social Security. This is a quick sort of overview view of a tool that we have on our BlackRock website, the Social Security Calculator. You only have access to this tool through your financial advisor, so please bring any of your primary insurance amounts, your Social Security estimates to your advisor, and they'd be more than happy and willing to walk you through this tool that they have access through our website. Married couples with a small difference in their benefit. So here, half of John's benefit is $1,100. That is less than Jane's benefit of $1,400. Instead of Jane collecting at full retirement, at age 62, we could have John file and suspend just like he did in the past. And again, this makes Jane eligible for a spousal benefit. because she will wait until age 66 to do anything, when she does that, she has the choice. She can collect just a spousal benefit. So she's getting $1,100 a month for 4 years and not impacting her own benefit. Her own benefit will continue to grow, and she can maximize it at age 70. So both of them end up maximizing their benefit. And again, Jane will assume John's benefit as a survivor benefit. This strategy gives us $1.2 million from Social Security. Again, maxing out your options here. If you are unfortunate enough to be a widow prior to the age of 60, you are eligible for survivor benefits at 60 instead of 62. So Wendy here might compare her own benefits to her survivor and just collect the highest. But the best way to maximize her benefits would be to start collecting one and then switch to the other. She could file for survivor benefits at 60. If you file for a survivor benefit at any point prior to age 62, that's the only benefit you're eligible for, so you can start collecting that without impacting your own benefit. She'll collect her survivor benefit until she reaches age 70, and then, fully maximizing her own benefit, start collecting that once she reaches age 70. Keep in mind, though, that if she starts collecting this benefit prior to full retirement age, as in this strategy indicates, you are still subject to those income limits. So you can't collect this and work a $100,000 a year job without having the decrease in your benefits. There are some additional beneficiaries who can collect off of your benefit. Divorced spouses. If you are married for at least 10 years, you are currently not married, and you are at least age 62, divorced for at least 2 years, you're eligible for a spousal benefit. So you can be divorced at age 62 and your ex-spouse needs to be at least age 62 as well. You can go to the administration and you can file for spousal benefits as if you were still married to that person. So you'd have 50% you're eligible for, and then any decrease that would be applied if you were to apply for it early at full retirement age. You need to be divorced for at least 2 years. If you were eligible for the spousal benefits at the time of the divorce, that number is not required. You're also eligible for survivor benefits. So if you were married to the ex-spouse for over 10 years, you are not married, or you married after the age of 60 and you're at least age 60, you're eligible for the survivor benefits. This is all acted as if you were still married, so all the numbers we just went over are consistent with a divorced spouse, and it is of no impact to any current spouse that your ex-spouse might have or any of their family. Taxation of Social Security. I am no CPA, so I will not talk past what is on this slide as far as the taxation of Social Security. Definitely consult a CPA on that, but provisional income, half of Social Security benefits plus your modified adjusted gross income gives you your taxation limits. So here, if you are filing single or filing married, here are your limits on either side. $25,000 or $32,000, you are not taxed at all on your benefits. The next bracket, up to $34,000 or $45,000 respectively, is up to 50% of your benefit is taxable. Anything past that, up to 85% of your benefit is taxable. So modified adjusted gross income really is everything in the kitchen sink added into half of your Social Security benefit. So think any wages, any Roth, any 401k distributions, any municipal distributions, anything from your IRA. All of this is all sort of rolled into one, attached to half of your benefit, and then it gets you to these limits. You can, when you apply for your benefit, indicate what you think your modified adjusted gross income will be in that year, and they can withhold taxes from you from your benefits so that you don't get a big bill at the end of the year, but they are taxable benefits. The next steps of Social Security. We've gone over at a very high level and pretty quickly some of the nuances here, but understand the fundamental rules. Recognize that you do have some options here. You do have strategies you can employ when you start looking at retirement with your Social Security benefits, and work with your financial professional to make the best collection decision for you, your retirement plan, your family, every sort of puzzle piece that goes along there. There's a lot of things to consider. We really hope that this was an informative discussion for you. And now I will turn it back over to Christine. She'll go through any questions that you may have typed up during the presentation, as well as any that you may follow up with now as we go through the last 15 minutes or so of the webinar.
Perfect. Thank you so much, Allison. That was all really great information. And as Allison said, we'll now start addressing some of the questions that have been filtering in. And please remember that if you do have any questions, you can submit them using the Q&A tool on your webinar menu. And as always, for any plan-specific questions, you can always reach out to your dedicated service team here at Pensionmark. Now, as we wait for a few questions to filter in, I'd like to take a minute to let everyone know that you can stay up to date on the latest retirement plan news and events via Pensionmark's Facebook, Twitter, LinkedIn, and YouTube pages. Links to our social media sites can be found on our website at www.pensionmark.com. In addition, this webinar is recorded, and the replay will be posted on our website on the Investor Education Center, as well as our YouTube page within 10 business days. And we did receive a question about receiving the slides, and you will be receiving the slides as well after this webinar at the same email that you received the webinar invite. With that said, we'll now turn to our first question. And this is it from Jackie in regards to slide 5 about individual benefits. And the question is the 35 years consecutive years or any 35 years you worked?
It's any 35 years you have a work history. So they will cherry pick the top 35 years. Each year that you have a higher wage, the lower one will roll off. But it is any 35 years in all of your work history.
Okay, great. Thank you so much. And we did have a few questions regarding spousal benefits after divorce. And I know you spoke briefly on that, but what about benefits for a new spouse after remarrying?
So your new spouse, if you're currently married to them, is eligible to spousal benefits regardless of any ex-spouse. So they can file if you're of 62 or older and your spouse is 62 and older, absolutely eligible for spousal benefits, just like we've reviewed today.
Great, thank you so much. The next question we have coming in here is do these same scenarios work if the spouse is on Social Security disability?
No. So Social Security disability, to my knowledge, starts whenever you are disabled, and once you hit age 62, it switches from technically being a disability benefit over to your Social Security benefit. So you can't sort of play with all the different strategies. You can if that individual that's collecting at age 62 is the higher wage earner, then you can stagger your benefit or you can wait until full retirement age to collect the spousal benefit. But my understanding is that the disability just continues and just switches over, so there won't be the ability to not collect a benefit at age 62 and defer until later. But I can check on that and get back to you.
Great, thank you, Allison. The next question here is going back again to the spousal benefits in regards to after a divorce. So the question is whether the divorcee and the current wife would they both have benefits at the same time, or is there a preference to one or the other?
They can both have benefits at the same time, and it will both be all that they are eligible for. It would be as if the other one was not collecting. And there's no way to know that both of them are collecting. The administration doesn't give you sort of a heads up, doesn't say, oh wait, you're going to get dinged because someone else is also collecting off of you. This might also be one of the reasons why the trust of the Social Security is sort of going into bankruptcy. But yeah, it does not impact any current spouse's ability to collect a benefit, nor does it impact the amount that they collect if there is an ex-spouse collecting.
Perfect. Thank you so much, Allison. The next question is in regards to where the webinar replay will be, and we will actually have the webinar replay on our website at pensionmark.com, as well as our YouTube page. So within 10 business days, that replay will be posted up on the website, or on either website, which you can go to and watch. And it doesn't look like we have any other questions coming in. So with that, I would like to thank you, Allison. And that will now conclude, oh, we just got one question coming in. So one last question for you, Allison, in the essence of time. Do 401k withdrawals affect Social Security? That's a great question.
It's part of the modified adjusted gross income. So I would definitely consult your tax consultant there as far as what the strategy is, should be withdrawing, but it's sort of everything in the kitchen sink gets thrown into that modified adjusted gross income. So it doesn't affect the income limits, but it does affect taxation.
Great. Thank you, Allison. Now with that, in the essence of time, that will conclude our question and answer period. And if anyone has any additional questions after the webinar, please feel free to reach out to your dedicated service team here at Pensionmark at 888-201-5488, or you can email us at info, that's INFO, at pensionmark.com. I thank you all for joining us today, and once again, Allison, I would like to thank you for taking the time to present today.
Absolutely. Have a great day, everyone.
And this now concludes the webinar. Thank you.